Good day, guys. It's your boy Collins FX again. And now we are looking at gold. Gold is very, very volatile. So, what I see here is an uptrend too. So, and I caught a lot of buys on this market. A lot of buys on this market. So, now, this is the trend line I drew before I started this video. So, and I said I need to make another video on how to spot a definite break of structure, like a nice break of structure in the market. So now this is the 4-hour time frame, but on the 1-hour time frame, you clearly see that the market is on an uptrend. So now on the 4-hour time frame, and we are looking for buys. The market hasn't opened yet because we are still on the weekends, and on Monday we are going to see what price will do. So now we're looking for buys, right? And as you can see, we can clearly see a reverse head and shoulder pattern here at this point. We can clearly see a reverse head and shoulder pattern at this point. Look at the two shoulders, and this is the head. And now we have this other block here. We have this other block with a fair value gap. If you want to spot a nice other block, you need to look for an other block that made a fair value gap, which is like 3 candles close. This is the first candle. Right, let me zoom in. Let me zoom in. Okay, now you can clearly see what I'm talking about. Now, this is the first candle. 1, 2. The candle that has a space in between it. That's where price will come and tap in to fill in the gap. Price will come and fill this gap here and also touch this other block that caused this break of structure. This break of structure here. Price went up, made a head, went up, made another shoulder that broke this structure here. See. Now price is going to go back to the other block that caused that same break of structure. And also note, after every break of structure, there's always an inducement. There should always be an inducement. Before you point out or spot a break of structure, always make sure that the inducement has been cleared. Like now, if you can look deep into this trade, you can see price broke this structure and now made an inducement here at this point. This low is the inducement. And now price has already cleared the inducement going towards the other block. The other block that caused the break of structure. Price is going towards the other block that caused the break of structure. And now what we should be looking for is how to find our entry and exit points. Now we're in an uptrend, like we know, in an uptrend. So we have these highs here. These highs. This is one high. And we have another one here. We have 3, We have 3 highs here. So we'll be looking at how to make an entry point from this other block to the highs price has made. And this is our last high, the highest point in the zone. Now what we should be looking for is placing a buy. Now, as for me, I'll place my buy under the fair value gap and extend it to the highest points of the zone and place my stop loss under the head to give me a better stay on this trade just in case price is looking to liquidate any point. So now I'll wait for price to get to this point. I'll wait for price to tap me in on this point and then reverse. And while I'm on this trade, I'll actually have to put in proper risk management. After price has, let me see, price got to this point now. Price got to this point. I'll have to put my break even at the break of structure. I'll put my break even at the break of structure just in case price comes down or hits this point, liquidate this point, and fail to pass through these points and started reversing. And I'm not actually active on the trading. So my break even is going to stop me at while giving me a little bit of profits in the market. So that's how what we talk about risk management. But I'm going to make another video of that about risk management. Risk management is one of the things that we traders fail to understand. And in my next video, or probably my other videos, I'm going to make mention of how to hold your capital while using a nice risk management on your capital, because your capital is going to define how you are going to calculate your risk. You understand what I'm saying? Your capital must always define how you are going to calculate your risk, because if you are using $100 account and you are risking like 50% of that account size, you will not be able to take 2 trades, you've blown your account. So in my next video, I'm going to make and teach you guys how to make a nice risk management using your capital. So thank you for watching this video, and if you find my video interesting, please like, share, and subscribe on my videos. Thank you.